This video is part of a series that will be explaining everything you need to know to become fully profitable in trading. I will keep it as real as possible and I will tell you everything. I'm not going to keep anything away from you guys, so make sure to watch all of these videos so that you can understand everything and finally start making money in trading. Today's topic will be daily bias. Here I have a list of 5 things that are arguably the most important with the way that I trade. And although everyone on social media talks about daily bias, they won't tell you guys these specific things that I have here on the screen. So let's get right into it. Number 1 is pretty self-explanatory. Mark out 1 hour and 4 hour highs and lows. So these are also known as draws on liquidity. So literally we have a chart here. This is on the 1 hour time frame, and let's say this is market open. You guys just literally mark them out. Simple as that. Remember guys, a high is a move up followed by a move down, and it's the highest of those two. And then the low is the move down followed by the move up, and it's the lowest of those two. These are highs and lows, just in case you guys forgot. So you guys mark out these on the mainly the 1 hour. Sometimes 4 hour highs, and then sometimes, if really none, then you go on the 50-minute. That is really rare though. Liquidity is the foundation of this strategy. So you guys have to understand and mark these out. Obviously, if price is here, if this is where the market opens, right? You're not going to mark out these here because and let's say this is like a really high time frame, right? This is like a day pretty much. There's like a bunch of candles here. Every swing point here is a day. You're not going to want to mark out these. These are like all-time highs. Price is not going to do that in one day, in one New York game session. So like in this case, you would mark out this and then go and see what previous highs there was in the past. And then there's probably a 1 hour gap somewhere in here, you know, stuff like that. So that is the first thing. Number 2, high resistance to low resistance. This refers to liquidity. This refers to the 1 hour and 4 hour highs that I just told you guys about. So what this means is essentially this, right? Just a really key swing high like this, like a really clean swing high. This is called a high resistance liquidity. Price moves from high resistance to low resistance liquidity, okay? And the reason I say that is because, like, let's say we have a market open, okay, accumulating here. In this case, yes, there are, for example, 1 hour and 4 hour lows closer to where the market is open, but the market doesn't want to come out and sweep out these lows most of the time because they're high resistance. Remember, the market wants to go where a bunch of stop and buy orders are resting. In this case, when there's stacked highs like this, there's a lot of sell orders. There's a lot of sell stops. So the market is most likely going to come up and take all those out. It might not happen the same day, but eventually it will happen. And the market will favor when there's a larger accumulation of lows or highs. Same thing with stacked highs. If there's this and this, then that means there's double the orders on these, which is why you guys hear people saying equal highs are higher probability, which is true. So with our strategy, we are usually trying to catch the low resistance liquidity. We're trying to trade towards there. Number 3, session liquidity. This is essentially you looking at the previous sessions, specifically Asian and London session, and seeing what they did and forming a bias based on that. Because usually New York AM session is going to play out based on the previous sessions. In this chart, we have Asian session is this. This is Asian session. This is London session. We have Asian lows down here, Asian highs up here, London highs, and then London lows as well. And the market is opening up here. What do you guys notice? No highs or lows have been manipulated. So usually what you want to wait for, and it's also the next thing on this list, is manipulation. But you use manipulation with the session liquidities combined. So in this case, you'd want to wait for price to manipulate towards a session liquidity, right? Because these are a strong drawn liquidity, and then for it to go towards the opposite session liquidities. You use them because let's say Asian makes a move up and then London makes the move down and sweeps out Asian low. And then this is where the market is open. London session swept out this Asian low. Since it already created the manipulation leg, you are expecting that New York continues and goes higher and distributes up higher. So that's how you want to use this, guys. You basically use the previous sessions, you see what happened during them, and then basically if we manipulated highs, like if both the sessions are like this, where we manipulated this high, and then let's say New York pre-market took out London high, you want to be expecting shorts. And then manipulation is the same concept, where essentially when the market opens, you don't just want to, like, you see price going up, let me take longs, right? This is where most people get stopped out. Because you guys enter here, whatever, then price goes down, stops you guys out, and then continues higher. So this is the manipulation like you most likely want to be waiting for on. The reason I said before or after market open is because London session manipulation counts as a manipulation. New York pre-market manipulation also counts as one. And then usually what happens is like within the first 5 to 10 minutes of market open is where the manipulation occurs. So that's why you guys want to be watching out. Last thing is understanding context. This is a little bit difficult to understand because it requires like some outside thinking. And like what I mean by that is you don't want to be looking too broad or too close into price action. You don't just want to be sitting on the 1 minute time frame and like looking at this move and like trying to catch this. You want to look at the higher time frames, right? You want to look at what 1 hour draws on liquidity are happening. But also, you don't want to just, let's say we have this here. This is like on a broader time frame, like a 1 day or a 4 hour, right? You see how we have a bullish SMT. But the thing is that if market opens like here or something, like price could definitely the way we trade is we're trading New York AM session, right? So we're mainly trading that like 1 hour candle. Basically the 10 a.m. candle is what we want to be trading, something like that. So you can't be looking at like the last 3 days of price action just to determine what the next 20 minutes are going to do. It doesn't make sense. But then you also can't be looking at the last 5 minutes of price action to determine what the next 20 minutes are going to do. You want to do a balance range. So that's why I say 1 hour and 4 hours sometimes. But like you want to mark out, you want to see the context of like where price is at roughly right now. Because we're not like scalpers. And we're also not like swing traders. You want to find a nice in the middle. And just remember this. Don't go too broad. Don't go too zoomed in. Find a good middle ground where you guys can analyze the charts and you can determine what price is going to do based off of that. So I'll leave you guys with that. I hope you guys learned a thing or two from today's video. Hopefully you can actually implement it into the markets. And thank you guys for watching. I'm out.